All right, let's get started. Hello, everyone. Welcome to the video seminar on asset management, and this is our third seminar. What we have done in the past is, if you have any questions, please type in the chat box, and I will bring those questions to the presenter. If you have a preference, you can also unmute yourself and ask the presenter directly. Um, in terms of timing, we have 75 minutes, and you can ask any questions during that period of time. We'll also enable. We also will, have it. If you want to stay after the presentation for a discussion, please welcome to do so. So today we are excited to have Yang Song from University of Washington, and he will be presenting his paper on the smart beta Mirage. And Yang, you have 75 minutes. Please go ahead and start.
Awesome. Thank you very much, Yuehua. It is a great pleasure to present this paper, the smart beta Mirage, co-authored with Shiyang Huang and Hong Xiang, both from University of Hong Kong. So we all know that exchange-traded funds, or ETFs, have experienced tremendous growth during the past several decades. In the ETF space, the farthest growing segment that has attracted a lot of attention is the so-called smart beta ETF, also known as strategic beta or alternative beta. I'm showing you here the assets under management of the equity smart beta ETFs in the US. As you can see, since the first appearance of smart beta ETFs in early 2000, the assets of smart beta ETFs have steadily increased to about 700 billion at the end of 2018, accounting for 20% of the aggregate ETF markets. So based on the forecast of BlackRock, by 2025, equity smart beta ETF will grow to more than 2 trillion in the US. So clearly, smart beta ETFs are very important given their sheer size and the rapid expansion. On the other hand, they're still relatively under-researched. So what is exactly smart beta ETF? So briefly speaking, smart beta ETFs are ETFs that track non-broad market indexes, often claiming to deliver excess returns through systematic exposures to asset pricing factors, or asset pricing anomalies, if you will. So arguably, smart beta comes directly out of academic asset pricing research. So to make smart beta more concrete, let's spend some time to go over some examples, okay? Our first example, the Vanguard Value ETF, a smart beta ETF offered by Vanguard. In its objective statement, Vanguard Value ETF says it seeks to track the performance of the CRSP US Large Cap Value Index. So the smart beta index in this example is the CRSP US Large Cap Value Index. Second example is the iShares Russell 1000 Growth ETF, offered by BlackRock, seeks to track the performance of the Russell 1000 Growth Index. In this case, the Russell 1000 Growth Index is the smart beta index underlying this ETF. So these two indexes are standard value and growth indexes. Let's take a look at some smart beta ETFs that track non-standard indexes. So the JP Morgan US Momentum Factor ETF, offered by JP Morgan Asset Management, tracks the JP Morgan US Momentum Factor Index, which is an index built in-house by JP Morgan itself. The objective here is to invest in a momentum factor. BlackShares US Quality Large Cap ETF seeks to track the Northern Trust Quality Large Cap Index, which is also built in-house, that claims to represent the quality factor. One more example, the Fidelity Low Volatility Factor ETF tracks the low volatility index that Fidelity built, presumably tries to get the so-called low volatility premium. More recently, the so-called multi-factor smart beta ETFs become very popular, which can freely combine multiple asset pricing factors altogether. For example, this PIMCO roughly dynamic multi-factor US equity ETF claims to track the research affiliate dynamic multi-factor US index. We have seen some representative examples of smarter beta ETFs and their underlying smarter beta indexes. So from these examples, you see that smarter beta ETF sponsors either construct smarter beta indexes by themselves, such as JP Morgan, Momentum, FlexShares Quality, Fidelity Low Volatility, or they collaborate with third-party index providers, such as Vanguard, Value ETF, iShares Growth ETF, and the PIMCO Multi-Factor ETF. Okay, so how should we think about smarter beta ETFs in the universe of asset management? So this figure illustrates how smarter beta ETFs often compare themselves to actively managed funds and to pure passive ETFs like SPY, which deliver market-wide returns. So the key feature of smarter beta is that they claim to follow transparent and rules-based index construction procedure. For example, JP Morgan Momentum ETF states in its prospectus that this index uses a rules-based risk allocation and factor selection process developed by JP Morgan Asset Management. So at the first sight, it looks like that smarter beta has many advantages over actively managed funds who are infamously known to trail the aggregate market after fees. For example, comparing to active funds, smarter beta is based on predetermined rules and is more diversified. Moreover, smarter beta charges much lower fees than active funds. On the other hand, smarter beta also seems to be superior than pure passive funds, as smarter beta claims to low down asset pricing factors, which are found by academic research to deliver excess returns beyond the aggregate market. By construction, passive funds only deliver market-wide returns. So it seems that people finally find the optimal way of asset management. Probably that's why BlackRock optimistically predicts that smarter beta will grow to more than 2 trillion by 2025. Well, when asset managers tell you something is really fascinating, then you really need to get worried about it, as their incentives are often not aligned with yours. So what could be wrong with smarter beta? Although smarter beta indexes are claimed to build upon transparent rules, in reality, the discretion in setting up the rules is just enormous. So imagine you work for an ETF company. So imagine you were to construct a value index, okay, upon which you're going to launch a smarter beta ETF to investors. So value is arguably the most transparent and widely studied factor, okay? So if you were to build a value index, you may use any one or any combination of the following indicators to define your value. For example, price to book ratio, price to earning ratio, price to projected earnings ratio, price to sales ratio, price to cash flow ratio, dividend yield, you name it. You have a long list. The degree of freedom in choosing the number of stocks and the weight of each selected stock is even infinite. So given the enormous computing power you have, you can easily build a value index with spectacular performance out of thousands, if not millions of backtests. Meanwhile, you know that investors often respond to stellar historical performance, as they are not very aware of the difference between backtested on-paper return and real return, okay? Then probably you want to present investors with great backtested performance, as their inflows ultimately make your pocket to grow. So in other words, smarter beta ETFs seem to have strong incentives to try thousands of combination so as to find quote unquote best index in backtests. So in this paper, we try to argue that smarter beta is likely to be a mirage arising from extensive data mining. Okay? So let me show you a real example to illustrate data mining in action. This is a real world example. XYZ is one of the world's major index provider. I'm not going to disclose the name of this company because this is recorded. But if I ask you to name 3 index providers, it is one of them. In 1997, it launched an index tracking a well-studied factor. Let's call it XYZ factor A index. So this line shows the cumulative return of this XYZ factor A index relative to the aggregate market. So as you can see, the XYZ factor A index failed to deliver excess returns beyond the aggregate market portfolio since its inception. In early 2015, XYZ constructed another index of the same factor theme, the XYZ enhanced factor A index. So from the name, you can tell that this new index was constructed to enhance returns of the previous index. So shortly, a smart beta ETF tracking this enhanced index was listed to investors for investment. However, as you can easily see from this red line, the enhancement only happened in a backtesting period before ETF listing. Once the smarter beta ETF tracking this enhanced value index was launched to investors and went live, the on-paper stellar performance quickly disappeared and trailed the aggregate market, just like the original index. Okay. To add some more meat, these screenshots are from the methodology document of the XYZ enhanced factor A index. The left one shows the rules that determine the number of underlying securities in the index at initial construction. And the right one shows the rules in determining the number of securities at a semi-annual rebalance. You might find that these rules are hard to read. Yes, that's true. They're quite intricate and can hardly be justified by any economic or intuitive rationale. So let me remind you that XYZ is one of the world's largest index providers, and factor A is one of the most studied factors. You probably can imagine what would happen for other smarter beta indexes. I think I have told you the objective of the paper. So more formally, we aim to answer the following question in the paper. First, to what extent smarter beta indexes are subject to smart data mining in backtests? So a different frame of this question is that how do smarter beta indexes perform in backtests relative to the actual performance after the ETFs are launched to investors? Just to be clear, returns from the index performance start date to the ETF listing date are on paper backtested returns and are not accessible to investors. Only returns after ETF listing are real returns and are investable to investors. Okay.
Hey, Yang, we have a question from Sugata.
Yes.
So is this an indictment of just the smart beta fund industry, or also the academic smart beta factor anomaly literature? And he said, I feel that there are enhanced value type of papers being written now.
This is all about smarter beta ETFs. It's nothing to do with academic factor. Okay. I'll talk about the sample shortly. So our finding is that the smarter performance of smarter beta ETFs only exists in backtests. After smarter beta ETFs go live, they quickly trail the aggregate market on average. Our second research question is that, does the proliferation of smart beta ETFs add value to investors or not? Our finding is quite disappointing to investors. That is, we find the large number of offerings of smart beta ETFs add little value, both in terms of excess returns and in terms of average exposure to desired factors. Specifically, we find that the later constructed smart beta indexes on average deliver lower exposure to designated factors, which I will show you shortly. Okay. As smart beta is, as I said, relatively under-researched. Before I show you the result, I want to spend some time talking about the data collecting process, which I hope could be helpful for later research. Okay. We're going to take a 3-step procedure. In the first step, we compile the list of US equity smart beta ETFs listed between 2000 to 2018 from the Morningstar Direct. To guarantee the data quality, we're going to require the smart beta ETFs to be also in a crisp mutual fund database and the information matches. In the second step, we hand collect smart beta indexes tracked by smart beta ETFs. That is, we first define the name of the underlying index through reading ETF prospectus. Then we manually search index information and index returns, either from Morningstar Direct or from the website of index providers. Third step, we require smart beta indexes to have non-missing returns 12 months before ETF listing. In the end, we get 238 smart beta ETFs whose underlying index returns are available at least 12 months before ETF listing.
Yeah, we have 2 questions. The first one is from Kevin.
Yes.
How quickly does the performance deteriorate? Is the speed of deterioration related to the length of the backtesting period, if that period can be observed?
How quickly? Can I defer that to 2 more slides, because I'm about to show the result. It's easier to explain with the results.
Sure. And we have a second question from Zhenshi. Could there be a causal effect of smart beta ETFs or smart beta mutual funds on the smart beta index returns?
Causal effects.
Causal, I mean, in the sense that I presume they launch it, there'll be trading, there'll be flow coming.
I see. It's similar to the story of decreasing return to scale. I'm going to formulate means that when flow comes in, suppress return going forward. I will rule out that explanation because if we look at relatively small and large smart beta ETFs, we find that the smaller ones experience a sharper drop in performance, which is not consistent with the story of decreasing return to scale. I'll provide more details. Yes, I will formally rule that out. Okay, this figure shows the total AUM and the number of smart beta ETFs in each factor theme category in our example. At the end of 2018, our sample accounts for about 80% of the US equity smart beta ETF market. Thus, we think our sample is representative. These shaded lines shows the smart beta ETFs of different factor themes in our sample. You see value, you see growth, you see a low risk, low volatility, momentum, quality, etc. One interesting pattern is the rapid growth of the so-called multi-factor smart beta ETFs. You can see from this dark blue area, which can freely combine or freely choose among multiple factors. On average, we have 159 months of back-tested returns from the index performance start date to the ETF listing date. Remember, these are on-paper returns and not accessible to investors. And we have 71 months of real returns after ETF listing. A pretty long history of performance, I would say, on average.
Yang, we
Yes.
have a question from Sugata.
Yes.
Would an equal weighted fund be included in your sample? For instance, the RSP equal weighted S&P 500 funds.
Yes.
What about smart beta mutual funds? Is there a reason you do not look at those smart beta mutual funds?
Yes, the point is that the first question, yes, the equal weighted ETFs are included. It's in this. I'm a little colorblind. This is purple category. Others include those equal weighted, or they classified as fundamental smart beta by Morningstar. As to the second question, I'm not sure smart beta mutual fund will publish their performance before mutual fund exists. So the point is to show that the smart beta index, we can find the index pre-ETF listing, so we can examine whether there are data mining involved in this process. So I'm not sure smart beta mutual fund can be analyzed for this question, for this research question.
So I personally have a follow-up question on the second one.
Yes.
For smart beta mutual funds, we know that Richard Evans has this paper on incubation buyers.
Yes.
Would you able to use the ticker creation day and still get some return data before that the fund is offered to the public?
Yes. As I will actually explain at the end of the presentation, the relationship between our paper and Rich Evans' work. Yes, potentially yes, but if you look at Rich's paper, the incubation period is typically very short, on average not on average, but mostly less than 3 years. So the pre-listing or the before mutual fund launch, the performance for mutual fund will be, the history of performance will be very short. But here, if you look at the back-tested returns of smart beta indexes, on average more than 13 years.
Okay.
Good. So so now let's take a look at the performance of smart beta indexes before and after ETF listing. Okay. As smart beta aims to generate, or they claim to generate returns in excess of the aggregate market, we use the CAPM model to evaluate smart beta performance. Specifically, we're going to use the CRISP aggregate market index as the benchmark. One can invest in this CRISP aggregate index through Vanguard at a cost of 3 basis points per year. Here's the result. It is very clear from this table that smart performance of smart beta indexes only exists on paper before ETF listing. The number of 2.77% means that across all the smart beta indexes, the average CAPM alpha before ETF listing is 2.77% per year. That is, during the backtesting period, smart beta indexes on average beat the market by about 3% per year. However, the red number means that once the indexes go live and become investable to investors, they trail the aggregate market by 0.44% per year. The pre and post listing difference is 3.22% per year, which is highly significant. So just to be clear, to make the pre-listing performance and the post-listing performance directly comparable, we use the smart beta index return rather than the ETF returns in the post-listing period. In other words, the performance decline is not due to the potential transaction costs of replicating these indexes. However, what matters more to ETF investors is the ETF return after paying management fees. In our sample, the average expense ratio of smart beta ETFs is about 30 basis points per year. So if we use after fee ETF returns over the post-listing period, these are based on the ETF return after fees, investors on average get a CAPM alpha of negative 0.87% per year after smart beta ETFs are listed. So in other words, smarter beta investors lose 87 basis points per year investing in smarter beta ETFs relative to a combination of aggregate market and a risk-free asset. So in the
Jan,
paper, yes.
We have two questions.
Yes.
First one is from Volume 1.
Yes.
How many independent indexes are there? How did you deal with cross-index correlations in calculating the t-statistics?
So the first question, we have 238 smarter beta ETFs and more than 220 individual indexes. So that's the sample size of the index. The second question here, we take when calculate the t-stats, I think we adjusted for the correlation of the same factor seen in calculating t-statistics. Okay. So
go ahead.
So in a paper, we also conducted several robustness checks, such as subsample analysis, or we require the smarter beta indexes to have longer history of pre-listing returns. The results are very robust. So this is the reality of smarter beta ETFs. So our finding indicates that smarter beta is very smart, but only in the back tests. Okay. In the next several slides, I try to find a legitimate reason other than our claimed data mining to explain this significant post-ETF listing performance decline.
Okay, so before you move on, Jan, we
Yes.
have several extra questions. The first one from Christian Chu.
Yes.
What about using these indices for diversification purpose rather than because they individually outperform? There is still value of a mediocre performing ETF if it adds to diversification. For example, a short credit fund could underperform but would serve as a good hedge.
A short, sorry, I don't get it. The short what?
For example, a credit fund, a fixed income fund would underperform but might serve as a good hedge. So essentially, they may not be going after alphas, they may going after diversification, betas, or others reasons.
I see. This is a very good question. So so first I want to clarify that we focus on equity funds, but the question is still valid. So why we look at alpha? Well, that's because smarter beta claim they can provide excess return in excess of the aggregate market. So we look at alpha. As to beta, yes. So people can still argue that smarter beta is valuable because they give people access to beta. But if you look at the data, actually, the later constructed, as I will show you at the end of the presentation, the later constructed smarter beta indexes on average deliver lower beta than the first offered index of the same factor seen, indicating that the large number of offerings, we would argue the large number of offerings do not add value in terms of average higher beta.
Okay, we have one question from Tong Yao.
Yes.
Could it be market timing? Launching a style fund when its style outperformed recently, thus demand is very high for that particular style?
Yes, that's the first alternative explanation we will try to rule out. Give me one slide.
Okay, and we have one question from Clemens Shine.
Yes.
Similar questions to Booleans. How do the results differ across strategies? For example, value versus quality versus size. Do you break them by style later on in terms of the factor focusing?
Yes, we will show some results. I will show some results later. But the short question is that in testing its performance, we also control for factor sim fluctuations or factor-wide benchmark, and the result still stays.
Right. I think Clemens is interested in whether you find any heterogeneity across different strategies. You might want to break them down show the results separately for different.
Exactly. So think about value versus multi-factor smarter beta. Clearly, multi-factor smarter beta are more opaque, and we should expect to see a larger performance drop. That's what we find, and which I will show you shortly.
Okay, we have one more question from Bolian One. Who
Yes.
is doing data mining? Those
Yes.
funds or our researchers, academia researchers?
Well, in this case, that's the builders of these indexes.
Okay, and we have
So
one
not
question.
us.
You want to clarify more on that question?
Yeah, I'm saying that I'm claiming that people who build this index try to, try to do some data mining to present investors, create back-tested performance. And in this case, it's not us, it's not academia.
Okay, we have one question from Vikas. Is
Yes.
there any evidence that investors chase the smart beta index that has the highest back-tested returns? That
Yes.
this would need multiple indexes starting at the same time.
I will show you later that we find that flows respond to back-tested returns, sort of justifies the incentives of doing data mining.
I guess because what Vikas had in mind is you have multiple indices started at the same time, let's say at a given month. Some has higher return in the back tested period.
I see.
Others has less. Do you find that cross-sectional?
Yes, we control. Yes, it's essentially we control for time fixed effects and factor sim fixed effects, which sort of speak to this question.
Okay, and I personally have one question.
Yes, please.
Where in this table you show you're saying they underperform by 87 basis point per year after adjusting for fees.
Yes.
My question is, if you look at this, do you need to use a factor return that is after fee? Essentially, you're using the Farmer French market factor. Do you need to use, does it make more sense to use our Vanguard total market return funds in this case?
Yes, we use the crisp aggregate market, but you can invest that ETF at a cost of 3 basis points.
Right. I personally would be more comfortable if you use just that ETF index return from Vanguard to see whether
the correlation is 99.9%, and the fee is 3 basis points. So the result will not change.
So you're saying you get an 84 basis point on the performance?
Yes. Yes.
Okay. Yes. And Christian Chu posted a comment that there's a cute YouTube video addressing Bolian's last question. Okay. I'll refer that, our audience to refer that YouTube for after the seminar. Okay, please go ahead, Young.
Okay, thank you. Well, great. Yes, let's do our job. Let's try to save smarter beta indexes. Let's try to find a legitimate reason other than our claim that they are doing data mining. Okay.
We have one quick question just came in.
Okay.
John. You also observe index returns after ETF listing, right? How do they
that's
perform?
this table about. This is based on index returns.
So you're using index return rather than the ETF returns?
Yes, in the main exercise, we use index return just to make the pre-listing and post-listing returns directly comparable.
Gotcha.
Awesome. These are great questions. Okay, let's do our job. So there are a couple of possibilities other than data mining. The first seemingly plausible explanation is that ETF sponsors strategically time their ETF listing. The second possibility is that factor profitability declining over time, as documented by, for example, Mackley and Pontiff. Okay. Under this explanation, what we observe is just a natural outcome of this general trend in factor profitability. Third possible explanation, I think raised by some of you, is related to decreasing return to scale. That is, investment flows into ETFs after ETF listing suppress returns of smarter beta indexes and smarter beta ETFs going forward. I would very much love to hear your hypothesis beyond these three possibilities, which we're going to rule out in a paper and later in my presentation. And we would really appreciate if you can let me know your hypothesis. So I will show you that none of this possible explanations can maturely explain the post-listing performance decline. And later on, I'll provide evidence to support our claim that a lot of the data mining has been done in smarter beta index construction. Okay, so let's go over these explanations one by one. So we first take a look at the strategic timing in ETF listing. Since we have used the CAPM alpha to benchmark smarter beta performance, strategic timing of the aggregate market is naturally ruled out. So what about factor timing and index timing? Let's take a look at them one by one. So according to this factor timing hypothesis, ETF sponsors list their ETFs whenever the factor that they track has recently outperformed the aggregate market. So possibly due to factor return mean reversion, the pre-listing performance is not sustained. Okay. So to rule out factor timing, we just need to control for factor-wide return fluctuations. So to this end, we benchmark smarter beta performance relative to the first offered index in the same factor theme category. In this way, we can control for factor-wide returns. For example, all value indexes are benchmarked to the Russell 1000 value index, which is the first value smarter beta index. All momentum indexes are benchmarked to the MSCI USA momentum, the first momentum smarter beta index. So this table shows that relative to the factor theme benchmark, we still observe sharp performance decline post ETF listing, which is similar in magnitude as the drop in CAPM alpha. For example, before listing, smarter beta indexes outperform the first index of the same theme by 2.85% per year on paper. When these smarter beta indexes go live from backtests, they trail the factor theme benchmark by 42 basis points per year, which is statistically significant. The drop is 3.27% per year. Thus, the hypothesis of strategic factor timing fails to work. By the way, this table also suggests that index timing fails to work. Under the index timing hypothesis, ETF sponsors list the ETF whenever the underlying index outperforms other indexes of the same factor theme. So as you can see from the table, the wider the time window before ETF listing, the higher the pre-listing performance that smarter beta indexes have. So this pattern is inconsistent with index timing, under which index return should peak around ETF listings. Okay.
Yang, we have one question from Beyond Khan.
Yes.
Do investors become smarter over time and recognize this data mining? That is, do flows react less to backtested return over time?
Not in the sample, but I hope after people know this paper, they will become smarter, at least smarter than smarter beta.
Okay.
Okay, because smarter beta is relatively new thing, I think it takes time for people to understand the trick within smarter beta. That's the point of writing this paper. Okay. The next possibility is that factor profitability is declining over time. In other words, the post-listing performance decline of smarter beta is just a natural outcome of this general trend. Let me bring back the same table in which we measure smarter beta performance relative to the factor theme benchmark. Okay. I argue by controlling for factor-wide return fluctuations, we have already ruled out the influence of the factor-wide trend. Second, quantitatively, the post-ETF listing performance drop here is much larger than the general decline in factor premium. Okay. For example, Trodia et al. Study 12 prominent factors or anomalies. They estimate that the average profitability of these factors attenuates by about 32 basis points per year. If you look at this table, the smarter beta index performance dropped by 300 basis points per year before and after ETF listings. Thus, these two reasons render this explanation implausible. Okay. The next explanation on our list is related to decreasing return to scale. That is, when smarter beta ETFs are listed, investment flows come in, suppressing returns going forward. We have sufficient evidence to reject this hypothesis. First, remember we use smarter beta index returns in the post-listing period rather than ETF return. So there are no transaction costs involved. Second, smarter beta indexes are well diversified so that diminishing return to scale is less relevant here in the first place. But still, to formally rule this out, we're going to have the following exercise. What we do here is that we're going to split smarter beta ETFs into two groups based on their average post-listing AUM. Then we compare the pre-listing and post-listing performance for the two subgroups. Panel A reports the results. One might worry that different factor strategies can have different capacity. Thus, in the second exercise, we split ETFs based on their average post-listing AUM within the same factor theme. So panel B reports the result of this similar exercise. As you can see, smarter beta ETFs, smaller smarter beta ETFs, these are the smaller ones, even observe larger performance decline. Either we use absolute size or relative size. Thus, strategic level diminishing return to scale also fails to work. Okay. After ruling out all these seemingly plausible explanations, we think that the most possible explanation is that the pre-listing outperformance of smarter beta is a result of data mining.
Yang, we have
Yes.
a few questions before
Yes.
You show your detailed evidence on data mining.
Mhm.
One is from Vikas.
Yes.
So far, you haven't shown that there is a menu that sponsors can choose from to construct the index, and that they choose the one with the highest backtested returns.
Mhm.
Wouldn't that be a direct test of data mining?
Yeah, I hope I could have this option, but you only see the outcome of their index performance.
Okay, we have one question from Sugata. Can
Yes.
you classify issuers into data miners and non-data miners based on past deterioration of performance versus backtests, and see if that classification predict future deterioration? So I presume he's interested in whether some index providers are engaging this more than others, and
Yes.
there's a consistent pattern.
Yes, that we have. Yes, I'm gonna show you an exercise, sort of showing that when smarter beta ETFs sponsors have more controls over index construction, we see a sharper performance decline.
Okay.
Okay, good. All right, so let me show you the pieces of evidence that we have to support our claim that there's data mining going on. Okay. So first, we're going to explore the degree of controls that ETF sponsors have over index construction. So the idea is that if ETF sponsors are keen to attract investment flows through backtested performance, then we should observe stronger effects in cases where ETF sponsors possess more controls in setting up the index. Okay. So what we do is that we're going to split smarter beta indexes into quote unquote homemade and non-homemade groups. So to be classified as a homemade index, the name of the smarter beta index should contain the ETF sponsor's name, or the smarter beta index is released around the same time as the ETF listing date. So examples of smarter beta ETFs track homemade indexes include the JP Morgan Momentum ETF. If you remember, it tracks the JP Morgan Momentum Index. fidelity low volatility ETF, which tracks the fidelity low volatility index. Examples that track non-homemade smart beta index include Vanguard Value ETF that tracks the CRISP Value Index, iShares Russell 1000 Growth ETF that tracks the Russell 1000 Growth Index. So I agree that this is a crude criteria, but we argue that ETF sponsors shall have more controls over homemade indexes, as these indexes are likely to be tailored specifically for the ETF sponsors. So if you look at the pre and post listing performance of homemade versus non-homemade smart beta indexes, homemade ones have better pre-listing performance, a CAPM alpha of 3.64%, and experience a sharper drop post ETF listing, which is 2.26% in performance drop, which we argue is consistent with our hypothesis. Okay. In the second exercise, I think this goes back to Clement's question. What we're going to explore the opaqueness or complexity of smart beta factor sim. So we argue that multi-factor smart beta indexes are more susceptible to data mining for two reasons. First, multi-factor smart beta can freely combine or freely choose among multiple factors, so they have a higher degree of freedom and are more opaque by nature. Second, the category of multi-factor smart beta ETFs has the largest number of ETF offerings, so they face more severe product competition, which further induces data mining. Even among single-factor smart beta, there are some heterogeneity. We argue that pure value and pure growth should be the least susceptible to data mining, as they are the most transparent and well-studied factor sim. So if we compare these different categories, indeed, multi-factor smart beta indexes have the highest pre-listing CAPM alpha and the lowest post-listing CAPM alpha, yielding a drop of nearly 5% per year in CAPM alpha. On the other extreme, value and growth indexes have the minus drop in performance, which is 1.76% per year. Okay, sort of again support our claim. Oops. Let's see.
Young,
Okay.
we have one question from Vikas.
Yes, please.
Competition may also induce sponsors to differ from each other. This is not data mining motive, though.
Yes, but showing spectacular higher and higher backtesting performance and drop more is an indicator of data mining, right?
Okay.
All right. In the third exercise, we're going to look at ETF sponsors' size. So it is natural that all else equal, smaller smart beta ETF sponsors have stronger incentive to increase their AUMs. Thus, we expect them to do more data mining than larger ETF sponsors, which may care more about their reputation. Okay. So specifically in this third exercise, we're going to compare the top 3 ETF sponsors: BlackRock, iShares, Vanguard, State Street, with the rest of the ETF sponsors. Okay. So this table shows that smaller ETF sponsors indeed have better pre-listing performance, worse post-listing performance relative to the big 3. Again, we argue this is consistent with our hypothesis of data mining. So in summary, these 3 pieces of evidence all support our claim that data mining in back tests cause the pre-listing outperformance and post-listing underperformance of smart beta.
Young, we have 2 questions before we move forward.
Yes.
First one is from Beyond Khan.
Yes.
In order for this data mining strategy to be successful in attracting assets, Investor flows should be sensitive to back-tested returns, but not to the actual performance after the launch. That is, investors are fooled by the back-tested return, but still remain in the fund after observing bad performance after the launch. How can this be plausible?
Well, the flow, I'm going to show you the flow relationship on the next slide.
Okay.
Yes, we do see that they respond to backtested flows. But remember that the backtested history is much longer than the live return because of most of the ETFs are offered pretty recently. I don't think we have power to tease out the difference between how they respond to backtested returns and how they respond to live returns. We wish we could do that. But my intuition is that investors cannot tell the difference between backtested returns and real returns.
Okay. And we have one more question from Volume 1. How do you explain the performance difference across homemade versus non-homemade and multi versus single in the post period? If pure data mining using pre-period data, post-period performance should be the same. So
I'm not sure I agree with that.
So if pure data mining using the pre-period data,
yes,
then I think Bonnie's point is then the post-period performance should be the same for homemade versus non-homemade, multi versus single strategy smart beta ETFs.
I don't think that I don't think that's true. Let's take a simple example. Suppose that the price of assets prices of assets are mean reverting, and suppose in history a stock has positive return and one ETF puts 100% on that single asset, then the performance going forward will be negative. And if you put less weight on that outperforming stocks, then going forward you have much less negative returns.
Mm-hmm. So, Bonnie, did Jan answer your question? I mean, you might, if you want, you can unmute yourself if you want to clarify your question. I think
okay,
we're good.
Okay.
Yeah.
So let me continue. Okay. Yeah. So of course we want to check that if investors really respond to stellar performance in backtests. Thus, we estimate the following flow performance regression. Here, the left-hand side variable is the average flow over the K months after ETF listing. Okay, and the right-hand side variable is the pre-listing CAPM alpha over the X months before ETF listings. So we also include time fixed effects, factor sim fixed effects, and we let K and S to vary. So moreover, we also use other pre-listing performance measures, such as factor sim adjusted return, and the results are similar. Okay, so this table shows the estimation result. It's pretty hard to see, but the last column basically means that after controlling for the fixed effects, a 1 standard deviation increase in pre-listing performance leads to an increase in investment flows of 6% per month over the 1-year period after ETF listing. Okay, these strong flow to performance, strong response of flows to on-paper returns strengthens our claim that ETF sponsors have incentives to boost the performance in backtests. Okay, so far I've shown you that smarter performance of smarter beta is likely to be a mirage as it exists only in backtests. After smarter beta ETFs are listed, smarter beta indexes quickly trail the aggregate market on average. In other words, smarter beta ETFs add little value in terms of returns. So one might still argue, I think some of you raised this question, that the proliferation of smarter beta ETFs is valuable because investors might get higher beta to the desired factors, which are not available to them before. However, we show that this is not the case. we find that smarter beta indexes mostly fail to deliver higher exposures to designated factors than the first constructed index in the same category. Okay. To see it, we're going to estimate the beta to the designated factor for the first offered index in each factor sim category, and the beta for the later constructed index in that category through multivariate regressions. And then we compare these two betas. For example, for quality smarter beta indexes, we estimate the following two regressions. First, we regress the first quality smarter beta index, the MSCI quality index, on the Fama fringe factors, the momentum factor, the quality factor of AQR, and the low volatility factor of on et al. And then we take the average portfolio of all other quality smarter beta indexes and estimate the same regression. We then compare beta 1 versus beta 2, and let's take a look at the result. So the blue bar shows the exposure of the earliest quality index, the MSCI quality index, to the quality factor. The red bar shows the average exposure of later constructed quality smarter beta index to the quality factor. You can see that later constructed quality index have lower average exposure to the quality factor than the first quality index. The same is true for momentum, for low volatility smarter beta indexes, and for growth. For growth, these bars shows that relative to the first growth index, later constructed growth indexes deliver lower average exposure to low minus high, the inverse of the value factor, indicating they have lower average exposure to growth than the first growth index. Only in the value category, later constructed smarter beta indexes deliver marginally higher exposure to the value factor. So in summary, we argue based on the evidence that the large offerings of smarter beta ETFs also add little value to investors in terms of exposures to desired asset pricing factors.
Young, we have one question from Savannah Ray.
Yes.
Maybe backtest data mining is correlated with other aggressive marketing techniques. Hard to causally link the added flow to just the backtest returns.
Yes. Yes, I agree. I think the literature of mutual fund has shown that marketing plays a role, but I would say that I look at multiple prospectus of these smarter beta ETFs. They do show their back-tested performance to investors, which I think is one of their marketing strategy.
Mm-hmm.
I'm not saying that backtest return is the only driver of flows. Yes.
That makes sense.
Okay. Actually, I think I'm running ahead of time, but let's continue. So last slide before I conclude, okay? We also look at equity smarter beta ETFs in other developed markets, including Europe, UK, Canada, and Australia. Smarter beta ETFs are growing very fast in these markets, although they are still relatively small comparing to the US smarter beta ETFs. So following the same data collection procedure, we are able to compile a sample of 77 smarter beta ETFs in these other developed markets whose smarter beta index returns are available before ETF listing. Then we use the MSCI market index in each region as our benchmark to gauge the performance, the pre-ETF listing and post-ETF listing performance of the smarter beta indexes. So this table shows that post-ETF listing return decline is quite universal. Over the backtested period, smarter beta indexes in these other developed markets outperform the aggregate market in their respective region, and this outperformance quickly disappears when the performance becomes live. Okay. Let me sum up by connecting our findings to the literature. So first, our paper is related to the literature that studies strategic behavior of asset managers. I apologize that here the list is far from exclusive, and many of you have contributed to this literature. To our best knowledge, I argue that we are the first to analyze the behavior of data mining in ETF listings. So the biggest takeaway from our paper is that the claimed smarter performance of smarter beta ETFs is likely to be a mirage that only exists in backtests. I would argue that this observation is important, as hundreds of billions of dollars have been invested in smarter beta, and trillions more I expect to follow. So as I mentioned earlier, a very relevant paper here is Rick's paper on mutual fund incubation. I think we will reach this point too. So a strategy that mutual fund companies use to test multiple new funds with only outperforming funds are open to public. There are some important differences between data mining and fund incubation. So in fund incubation, real capital is deployed. In contrast, data mining is entirely backward-looking, okay, as it searches for superior returns from historical data. Moreover, as I mentioned earlier, the incubation period is relatively small, mostly less than 3 years. The average length of backtested returns in our sample is more than 30 years. So there are some difference. Second, our paper is related to the growing literature that analyzes the influence of ETFs on the financial markets. Prior studies find both positive and negative effects of ETFs. Our paper highlights the risk of ETFs data manipulation, which is detrimental to investors. Lastly, our paper is related to the recent literature that questions the reliability of SR pricing factors or anomalies, as many of them stop being profitable out of sample or after publication. We show that arguably the most accessible vehicles for factor investing, smarter beta ETFs, suffer from data mining and fail to work for investors. It is a great pleasure to see that our research has attracted attention from practitioners and investors. This is a Bloomberg News that report our research 3 weeks ago. Hopefully, after seeing the report, our findings, some investors, at least some investors, could become smarter than smarter beta. Yeah, that's all. Thank you very much for your attention and for these great questions.
Great, thank you. So we have time for more questions. We have one question from Xu Guo. Have you compared the difference of data mining strategy between smart beta ETF and other type of ETFs?
Other types of ETFs. So broadly speaking, there are 3 types of ETF. Well, one is the broad market ETF, like the SPY. Then it's the smarter beta. Then is so-called thematic ETF. And in some ongoing work, we are analyzing the so-called thematic ETF, which are very popular these days. And we do see that on average, they underperform the aggregate market. We are in the process of showing more evidence. But my takeaway is that these ETFs deviate from broad market index are pretty intricate, and there are a lot of tricks going on.
Okay, we have one question from Tong Yao. Just a thought, after index providers launched an index, it seems that the index still outperformed for a period of time, but after an actual ETF got launched, the index started to underperform. So the index providers are still innocent?
I'm not sure I exactly get the question, but if you look at the sample, you know, in many cases, smarter beta ETF sponsors build the index by themselves. And we show that if they have more controls, the performance decline more. And if you look at, does that speak to the
So I think Tom's question is exactly what time period, at what time point does the performance start to deteriorate? Are you able to test? Is it because it's after the index launch or after the ETF launch? Or in any case, it's actually the identical time. You couldn't differentiate.
I see. I see. Sorry for misunderstanding. In a paper in a robustness check, we also look at compare performance before index launch and after index launch, and the results are pretty similar because the median interval between index launch and ETF launch is just 5 months, so they're pretty similar.
Okay, we have one more question from Dave Brown. Have you tried building your own optimal back-tested strategies? How well do the implemented strategy perform relative to the universe of potential strategies? For example, are they in the top 1% or 10% of the strategies?
We haven't done that. I think the idea is that if we know the actions, if we know the available action sets of each ETF, then we can simulate it to see, what the observed performance is in what percentage of that simulation. But the difficulty here is that we don't know the feasible action sets for smarter beta indexes, which makes this exercise hard to implement.
For many of the indexes, you don't know all of their choices being made. It's not like 100% transparent.
Yes.
Okay. Do we have any other questions for Yang? If not, we will conclude here. I will stop recording. I will leave the room open for any discussions after the presentation. Thank you very much, everyone. And I look forward to seeing you visually for our next seminar.